Top of the morning, everyone, or afternoon, nighttime, wherever you guys are tuning in. My name is Felix, and in today's video, it's probably going to be quite a boring one, but one of the most important topics that I feel like a lot of us missed out on or haven't really studied too much, especially in college. I came from a marketing and finance background, so a lot of the things that I learned in college, I'm finally able to really apply it mainly into my business. And in this video, I just want to do a step-by-step tutorial of planning for projections for for next month when it comes to my business, and how you guys can take sort of some of the frameworks that I have and kind of like add it into your own service-based business or whatever online business that you operate in, right? So again, in this context really matters. I run a online funding company. We sell educational programs, and then we also have a done for you service, done with you service that we help business owners, entrepreneurs obtain funding, and we help them crowdsource, or we help them find investors, or even raise capital from different institutions and banks as well. Okay, so with that being said, let's get right into it. So actually, one more thing before getting into it, I feel like a lot of people really miss out on why this is such a important thing to do within the business. And like Warren Buffett said, accountant is pretty much the language of business, and you fully need to understand it and really conceptualize it in order to grow, right? We do see a lot of people really miscalculate certain stuff within their business when it comes to like overpaying for projects, and they work their asses off pretty much the entire month, but towards the end of the month they're just like looking at their bank statement and saying, hey, what's going on? It seems like we have all of this cash coming in, but then towards the end of the month all of it went out, and I don't really have any owner's draw or enough money to kind of like take an owner's draw in that case, right? So at the end of it, they're probably just paying themselves like pretty much minimum wage based on the amount of time, effort that they invest into their business. And the whole point of building a business is for you to really create that lifestyle and build. And also it depends on your goals. You can scale it all the way as well. But again, like the well, what am I trying to say? The basics of it is that you just really need to understand where your money is going, coming in and out, what your projection is looking like. Hey, are you overspending on a certain department? Are you planning for pretty much how you're going to hit certain revenue goals or cash collected goals for the next month? And by doing this exercise, I think it's pretty much going to give you some insights and understanding, and it will also help you reverse engineer you know, into what you should be doing as of today in order to hit that 30-day goal from this point on, right? So let's do an exercise. This is for my own exercise as well, so you guys can see live time on how I do it. But basically, we're going to start over here. I have three different products. I have what we call our AFP product. That is pretty much the total price point for that is 6,000. We also have a different program which is $12,000, and then we have what we call low ticket offers, which is a combination of like $29, $1,500, $500, and then essentially I take the average of that, add up all of the price points divided by how many price products that's been added up in that formula, and then that will come up to like the average cost of those products in this case, right? And that came out to 650. So on this end, I'm pretty much what I'm doing is multiplying that by whatever the price point of the product is, and then what I'm going to do is pretty much what I like to do is kind of like set projections again, like what is my revenue goal for next month, and let's just say I have a target of hitting 150,000, right? 150,000 in total revenue, right? And then it's going to be a accumulation between this product, and this product, right? And then just based on how I did last month or the month previously, I can kind of like take the average of those 2 months based on each of those products and the units that was able to sell, and then kind of like add a increase to how much I want to at least close for next month, right? So let's just say I closed two of these programs last month. I want to project to at least close five this month, so I'm at least showing progress and promoting this, and it will also help me understand in order to hit that 5 unit goal for this program, I need to be promoting it, or make sure that we're kind of like marketing it twice as much compared to last month in order to hit this target, right? So in this case, it's going to be projected 60,000 in revenue. AFP last month, I think we did like at least 8 units, right? So this month I want to project that we at least do like a 30% increase of last month. So I would just aim for 11 units at, again, with the average cost value of 6,000 in this case, right? And then, okay, so that's 126, right? Maybe I know for a fact that we're not able to sell 24,000 worth of low ticket products just because right now it's not that automated in a way. And I feel like it's a lot easier for us to sell one of these as compared to selling multiple of these in order to hit that target. So I will try to aim for six in this case, and then I will try to aim for, what is 12,000 left divided by 12,000 divided by 650 in this case will be 18 units, right? So I have to sell 18 units of the lower ticket offer, which is pretty doable. Okay. Um, yeah. So basically, okay, so now I have all my projections. Again, like if my goal is to hit 150,000, I'm reverse engineering, based on the different products that I have, the price point, and then sort of like what I did last 2 or 3 months, and then just try to add some, increase for this month. So we're at least progressing and getting better. Okay, cool. So offer one is this, offer two is this, and then low ticket offer for me is anything under 2,500 in this case, and that will be over here, right? So what we're gonna do next is basically the formula is going to kind of like calculate your projected cash collected for each of these products, right? So what you have to change is kind of like everything on the green column here. So for example, offer one, 6,000 AFP products. What am I expected to collect in terms of cash up front, right? Obviously, there's people that does payment plans. There's people that does 2 months payment plan, paid in fulls, or 3 months payment plan, right? So what you want to do is kind of look back at the data of like last month or the month previously, and then kind of like average that out, right? So let's just say, hey, out of 10 people, 5 people paid in full, and the other five kind of like the payment plan, right? So basically, 10 divided by 2 in this case is 50%, right? So I did my numbers. I understand that, hey, right, at the end of it, some people pay in full. That's great. Some people will do payment plans, but when it averages out, pretty much we collect 45% of upfront cash in most cases when it comes to selling these products, right? So basically, what it did is it took 45% of this value, the projected value on the number of units you want to project to hit this month, and it came out with this, right? So this times 45% is 29,700 in cash collected, right? It also help you calculate refunds. So basically what you want to do is make sure you go back to the months, the past 3 months, look at your, expected refund rate in this case. Anything above like a 1.8% is pretty bad in our standards, so we try to keep it low. That's where we try to understand, hey, what type of support system can we put into place, what do we need to revamp or revise our customer service experience. But for me, I try to aim for 1.4% or lower, right? So in this case, it will automatically calculate, hey, most likely there are going to be refunds. That's the cost of doing business. The average refund rate that we, typically, you know, yeah, typically average is 1.4% in this case. So it'll automatically subtract $415. So you can see parenthesized here. And then pretty much cash collected will be, yeah, for pretty much this offer when it comes to 45% of the time, or 45% of the cash collected upfront, the revenue will be calculated into here, right? AR cash is basically account receivables, right? So let's just say the month previously, so let's just say you sold someone a 6K package the month previously, but they only paid 3K upfront and they're supposed to pay 3K this month. What you want to do is kind of like add all of your accounts receivables in this section here, right? And then basically expected percentage, what it means is like out of all of the payment plans that are due for this month in your company that that came from closes that happened the month before or the month previously, or it depends on whether it's a 2 or 3 month payment plan, how many of that is expected to be paid, right? So obviously you're going to deal with your the payment card getting declined, maybe insufficient funds, and then your team try to reach out to these people, but they still don't answer you. Therefore, it goes into collection, right? So it's not going to be 100% of the time when it comes to collecting all of your account receivables. So based on our experience, and when we calculate everything, it's just like 70% of the time we're able to collect on the second month of when these AR build or yeah ARs are due, right? So for example, I think this month we're looking at 35,000 in account receivables, right? So and we're projected to at least collect 70% of that, right? Rather they're on a payment plan or on a performance plan with us, and we're projected to at least finalize everything, or the payment is due of this month, what percentage of that payment is going to be collected. In this case, it's going to be 70%, right? So we add up all of these numbers, and then automatically, if there's any, refunds when it comes to the payment plans, it might happen. 5% is pretty typical, I would say. It will also subtract from the AR amount, right? So now you add together from this one product that you offer, what's the upfront cash collected, subtract refund, what is the AR cash collected for this month that came from the sale that happened a month ago or a couple months ago, right? And you add those two numbers up, and this is where you hit 52,000 cash collected for just this offer, right? So um, similar projection for offer number two. Maybe since this one is a higher ticket offer, when it comes to cash collected, you will only collect like 30% of the cash collected upfront. In most cases, a lot of people they don't like to pay in full when it comes to such a high ticket item. So 30% of 12,000 is basically 4,000 upfront, and then 4,000 the next month, and then 4,000 the third month, right? So basically, for us, in this case, 30% of 6 units, 30% of what 6 units is value to at 72,000 is 21,600. And then AR cash is again, what is due for this month coming from the payment plans that happened from last month, right? So maybe it's like 8,000 in this case, or 9,000, for example, right? So I think it was 8,000, right? Yeah. Refund, yeah, I haven't really calculated that, but you guys get the gist of it, right? So, and then basically at the end of it, it's crazy. Some people do finance the low ticket offer. Again, my low ticket offer, definition of low ticket offer is anything under 2,500. In most cases, we collect 80% of that upfront. And then, AR cash, maybe like, let's keep it simple, like $800 from small payment plans that we offer, right? And collect 100% of that. Okay, cool. So basically, came out to 89,000 in total cash collected between these three offers based on the percentage of upfront cash collected from your sales team or from yourself when it comes to each individual offer. And again, that is based off of data. You guys don't want to just throw out a random number there. You want to at least look at data that happened in the past 3 months, right? Just calculate everything, go through all your stripes, go through all your payment plans, your different products. You guys should at least keep track of each individual product, how many units is being sold, what the CPA per offer that you have, right? A lot of that goes into planning and really understanding your number, right? And it really reflects back into the business, and that's where it differentiates profitability and not being profitable at the end of the day is how prepared you are and how much you know your number in this case, right? So what's this is just like for advertising marketing costs, I like to always keep that around at 25% of whatever the cash collected amount. So it'll automatically populate saying, hey, if I'm projected to, hit 150,000 revenue with all of these numbers being the same, and 150,000 revenue, 89,000 of that is actually cash collected up front, then I should be willing to spend up to 25%, 22,000 into marketing, client acquisition costs, or paying referrals in order to acquire customers, which is considered 1 unit each for these offers that I have, right? Labor, I like to keep at 30%. 30% of the labor is, if you have way less than that, then obviously you have so much more wiggle room and profit in this case into your pocket. But keeping it at 30% is pretty essential as well. And then 30% for overhead when it comes to like software costs, legal fees, any of that, contracting costs, etc. Actually, contracting costs goes into labor, right? But you guys know what overhead is, like anything that it takes to run a business, excluding your labor in this case and your marketing, right? Labor would also accounts for your sales commissions. Um, I would exclude owner's draw, so basically the salary you pay yourself, but salary that you pay your team essentially, right? So basically, the net profit margin, if I were to hit all of these numbers and it being constant, it would bring me at least a 32% profit margin, and I will be taking home 28,000 in this case. That's only if I hit all of these numbers, right? But obviously, for me, when I'm looking at this, like I'm probably going to be paying a lot more for overhead. I think overhead, let me double check my stuff. My overhead, actually, my overhead is averaging 9% last month, 11%. So 10%. So I would say it's 10%. Overhead is like pretty fixed because these are fixed expenses. It doesn't really change as you scale. That's the way that I look at it. Maybe it does sometimes, but I would just say it's not too much. Labor, labor, obviously, as you start closing more deals, especially if you have a sales team, the more commission you pay, and therefore labor goes up, right? Um, Payroll would be, yeah, I think this is pretty realistic. Okay, yeah, this is still pretty realistic. Yeah, so 35%, it's pretty good net profit margin. I would try to aim for like 48%. That's kind of like my goal, right? 48% is sort of my goal in this case. But this is essentially what I do on a month to month basis. I just make projections like this. It'll just help you understand, and then you can reverse engineer, everything at this point, right? So now I did all of my projection here. I understand, hey, if I were to stay constant with, at least getting 35% profit margin at the end of the month, given the projected revenue that I want to hit, and what is the baseline expense ratio when it comes to your marketing costs, your labor, and your overhead, then you will understand, hey, this is probably what I need to spend in order to hit this, or to hit the cash collected goal, number one, and then to hit your revenue goal. And then you need to understand what your CPA is, right? So your cost per acquisition. So let's just say your cost per acquisition for a $6,000 product. Let's do an exercise here. $6,000 product. Cost per acquisition is $1,000 on average. CPA on average. So how would I calculate that? So if I'm spending 22,000 in marketing spend, I think okay, hold on. Okay, so divided by total units. Okay, got it. Okay, so 35 units between three different products. Okay, so 22,419 divided by 35 units. 640 CPA. Okay, got it. Okay. But, okay, got it. So this number is kind of skewed. And the reason why is because I don't know how much in marketing am I spending on each offer, if that makes sense, right? Yeah. So if my CPA for this product is 6,000, is $1,000 for this offer, 6K offer, and I'm projected to hit 11 units, 11 units. So I just multiply 11 times 1,000 in this case. It will cost me $11,000 in order to hit 66K. So I need to allocate $11,000, which is 50% of my marketing budget of that 25%, right? So $11,000 would need to be allocated into this offer. And then probably the other 50%, I need to strategically allocate it into these two offers here, right? So that helped me understand a little bit more. Now I can be, I can think one step ahead and try to lower the CPA, right? Maybe it's my closing rate or my show up rate. If I increase my show up rate, if I increase my closing rate, my CPA will probably drop to like 600, let's just say, for example. Now, in order to hit this goal, let's just say it cost me 11 units times 600, it's only going to cost me 6,600 in this case. 6,600 of 22,000. That's going to be 30% of my marketing budget, projected marketing budget allocated to this offer in order to hit this projected amount. Does that make sense? Right? So basically what I'm saying is just take your average CPA when it comes to each offer, multiply it by your projected units, and see whether or not that surpasses your marketing acquisition costs. If it does, if it's over like 25%, for example, then you're probably paying way too much in marketing, or your CPA is just too high in that case, if that makes sense. Right? That might also come down to other variables like your closing rate might be too low. So you need to fix your back end part before you're spending more on ads. Or you have to fix your closing rate and your show rate before you scale your ads in this case. So that's kind of like the bigger picture of things, right? Labor, 30%. Again, labor is pretty fixed with half the department, and the other half is not fixed, is more variable, because as your sales team close more and it's commission based, then you got to pay out more commission in that case, right? The more unit that you sell, the more commission that you pay, right? So that number is always going to be correlated with the amount of units that you sell and cash collected that you make for this month, essentially. Overhead, a lot of times is, I would say 90% of the time, your overhead should be fixed, right? Uh, yeah. Yeah. So overhead can be your merchant processing fee. That's considered overhead. That's not fixed, really. That's variable, right? We pay like almost close to like 4%. I calculated that. I'm just like, dude, I switched from Stripe. I'm paying like 1% more. It's crazy. It's absurd. So I'm going to negotiate with them, right? So now I understand. Like the more I dive into the numbers, right? If I can even save 1% from my merchant processing fee, you reduce this to 9%, right? So see that number now, 8967. I save $900 a month. That's a fucking Porsche right there. You get a Porsche, you can rent a Porsche, or you can finance a Porsche for that amount. Maybe like an old one. But you guys get what I mean, right? So that's consider your merchant processing fee, your software costs, bank fees, legal fees, bookkeeping fees, agency fees, right? That's what I consider overhead. Yeah. So it's pretty fixed most of the case, in most times, right? Yeah. And you know what's the crazy thing? Crazy thing is, like you're not even factoring taxes, right? So that's the cost of running a business. It's tough, man. Like people think 35% is high. It's just like wait until you have to pay taxes on that. You're really essentially taking home like 15% in this case for all of this work that you're doing, right? Cost of doing business, right? You gotta know your numbers. But hope this is helpful. Let me know if you guys have any questions. See you guys in the next one.